In this video, we will be discussing funds, focusing on section 1.1, exploring the world of funds. Just to give you a heads up, the entire section 1 will be non-technical, offering a general conversation about the industry and its background based on my 10 years of working experience and additional research. If you're looking for the technical aspect of fund accounting and financial reporting, please feel free to skip ahead. So, what is a fund? A fund is essentially a pool of capital contributed by investors and managed by professionals to achieve specific investment objectives. Here is a look at some broadened categories of funds. Mutual funds are pooled investment in a diversified portfolio of stocks, bonds, or other securities. They trade at the net asset value or NAV at the end of each trading day. Exchange traded funds or ETFs. ETFs are similar to mutual funds but traded on stock exchanges throughout the day. They often track market indices and offer flexibility with lower expenses ratio. Hedge funds. Hedge funds are actively managed by funds available to accredited investors, employing diverse strategies and investing in various asset classes, often with a higher risk. Private equity funds. These invest in private companies or buyout of public companies, often restructuring them for growth before selling at a profit. This category include various subtypes, including buyout funds and growth equity funds. Venture capital funds. While technically a subset of private equity funds, venture capital is often considered its own category due to its focus on early stage startups with high growth potential, providing capital in exchange for equity stakes. Real estate investment trust or REIT. REITs are companies that own, operate, or finance income producing real estate, offering a way to invest in real estate without the direct property ownership. These categories represent the main type of funds, but you may encounter more specialized varieties in the industry. The model I will guide you through is specifically tailored for private equity funds. I am a visualized learner. I like put items into visuals. In my little complex world of funds, we just walk through the type of investment funds. Next, we're going to understand my focus, private equity funds. These are the subcategories of private equity funds, and these are the key components. Private equity involves investing in privately held companies, typically through funds managed by specialized firms. The goal of these investments is often to enhance the value of the acquired companies and eventually sell them at a profit. This process involves strategic improvement, operational enhancement, or financial restructuring to boost the company's performance and attractiveness to potential buyers. So the key component of private equity funds. So the investor input is capital provided by investors. The goal is to achieve a return on invested capital. The risk is the possibility of losing invested capital. The fund is operated by experienced fund managers to optimize the returns and mitigate risk. Within the broader category of private equity, there are several main subcategories. Leveraged buyout or LBO funds. These funds acquire controlling stakes in mature, cash flow stable companies using a combination of debt and equity to finance transactions. Growth equity funds invest in established growing companies that need additional capital to expand, typically taking minority stakes. Venture capital funds. While often considered a separate category, venture capital is technically a type of private equity that focuses on early stage startups and high growth potential companies, usually taking minority stakes and focusing on sectors like technology and biotech. Real estate funds. Real estate funds focus on real estate asset and development. And also we have mezzanine funds, which provide subordinated debt to facilitate leveraged buyouts or other transactions. And then we have instruction funds to invest in large-scale infrastructure project. And you may have heard secondary funds. They purchase existing stakes in private equity funds from other investors. And then we have many funds of funds as well. Funds of funds invest in other private equity funds rather than directly in companies. So it's worth noting that these subcategories can sometimes overlap and the lines between them have become less distinct in recent years. Each of these subcategories, they have their uniqueness, and I have put these into a table. And this table lay out the difference among the four main subcategory types by risk profile, return potential, investment strategy, typical investment stage, use of debt, ownership stake, investment horizon, exit strategies, value creation, investor profile. In addition, as I specialized in private equity and venture cap fund accounting and financial reporting, I added some details of these two type of funds. They are similar with each other from many aspects, but they have some main difference here. Venture capital in general has higher risk and higher return, hopefully, and they are different from debt investment, company focused growth trajectory, and other aspects as well. And here is a summary for your reference. All right, so this is a quickly walkthrough and the introduction of the funds. Next, we will talk about private equity fund structures and operations.